A very good morning to all of you and welcome on this Sunday and rainy morning. Being July season, I think today's topic is very important and apt. When we file the returns of individuals, nowadays we see that they are investing into a lot of non-traditional areas of investment, be it AIF, InvITs, REITs, and others. So, to explain about the taxability of various kinds of investment instruments, we have with us CA Haridas Bhatji, who's also a past convener. He will be taking us through taxation aspects of various investment instruments like shares, mutual funds, bonds, debentures, gold, artifacts, AIFs, REITs, and etc. So before we start the meeting, I would request you all to please put your phones on silent mode. Also to stand up for the institute motto, sir. Request you all to please stand at attention mode. Please keep standing for the national anthem. Okay. Thank you. Our today's speaker does not need introduction at this study circle, but just for the protocol, I would like to invite CA Jayesh Shaji, who is also a past convener, to introduce the speaker for today.
Good morning, all. I'm thankful to the convener for giving this opportunity. As mentioned, Haridas ji doesn't need any introduction to this gathering. He still, as a courtesy requires for the benefit of new members, I'll just formally introduce Haridas ji. He's a practicing chartered accountant since 1986. Specializing on income tax matter, and he has handled various corporate multinational corporates and individuals' HNIs matters. He is regularly attending ITAT, Mumbai, Pune, and Ahmedabad. He has served on various committees of WRC and Institute of Central Council. He is a member of Direct Tax Committee of Chamber. He has authored various articles. He's a regular contributor for and compiler for our budget booklet, which is published for so many years. He's a past convener of JV Nagar. That doesn't need any introduction. And he is a recipient of various awards from the various institutions. He has worked, apart from professional work, he is very active in social causes and serving on various posts on the various organizations. With this short introduction, I request Haridas ji to take us through on the very current subject, which is very apt and required for the members. Before he'll deliver the talk, I request Sri Navratan ji Jain, our past convener, to present a moment on behalf of all of us to Sri Haridas ji. Thank you. Haridas ji, please.
Good morning, everybody. Good morning. I think everybody is interested to know the taxation, investment, etc. That's why with the rain also I can see almost the full house. Anyway, let me tell you, because for this session I myself studied and came like exam. So if there is something unanswered questions, I'll answer later. Whatever the queries possible, we'll answer. Otherwise, we can definitely, I can touch, study that again and give an answer. And first of all, thanks to Purvi for getting such an out-of-box idea for a lecture. And for the good words given by Jayesh Bhai, and the big box given by, I've brought a big car, so no problem, I can carry that. So let's start the day, and I'm not going to, give my opinion or advice on what to invest. That we have got better people to give that. Mahesh is sitting there, and I will give my turn later. So we'll restrict to the taxation only. It's not my laptop. It's not. It's refusing to move forward. Yeah. Before we start, let's see what are the types of investment. So practically, you have got some long-term investment where you have to go. The tax planning is necessary, and there are short-term investment. Short-term investment usually is on two things. You make a decision. One is depends on liquidity. That by definition, short-term is liquidity. You want money at a short call, so you make the short-term investment. And when you make a short-term investment, your risk appetite is very important. So if you got high risk appetite, you got high risk items, low risk appetite, low risk items. Even when you go for the mutual funds also, risk-wise, they got separate products. We'll come to the item-wise later. Then there is basically tax-saving investments. When we started practice or in the beginning, all the investments are restricted to tax saving only, because those days government used to give a thrust for the taxing investment so that everybody makes some small investments. Now that is gone because now the government doesn't want you to invest in LIC also. Forget about all other things. And the benefits are all withdrawn. We are in the different tax regime and different tax era where you pay lower tax but don't get any benefits. So that is when you make the taxing investment, you have to look at the two things. One is tax saving and another is return on investment. Then the finally business investments. Then business investment I'm not touching because the taxation is depends on the earning. What are the long-term investments? Yeah, first thing when the long-term investment, everybody thinks about it, the real estate, immediate property. See, Indians I'm not talking about the current generation, our generation. The real estate investment is for the safety and security more than investment. But now things are different. That way, if you see the return on investment on real estate property, it's not worth it. With the house you are having here, with the interest, you can stay in a 5-star deluxe hotel. That is how costly the property investments are. But we are in that generation, that era, that where we feel that security is more important. We want our own house, so invest. So less people invest on the house as an investment, more people invest on the house as a security measure. Then there are shares. Yeah, today if anybody asks where to put money, definitely shares because it's galloping. It is not just running; it's galloping. So when 2 years back, when one of the budget sessions when they said it will touch 60,000, we're telling, "Arey, what is telling?" But now we are beyond 60,000. Then there are mutual funds. Now we'll come to the more details on that. Then there are deposits because deposits usually that is considered as they call it technically as widow investments. Means you don't want to take any risk, then you invest on the deposits. Then there are bonds and debentures. This is less explored area because people do not invest much on bonds and debentures because there are so many people have burnt their hands in those public deposits and bonds, etc., of sham companies. So even the good companies issue the bonds also, there are less takers. Only that institutional investments, others put in bonds and the mutual funds. Individually, hardly any people put on the bonds and debentures. Then there is gold and precious stones. Now, gold and precious stones, let me tell you one thing, that's buying a jewelry is not an investment. Because once you buy a jewelry, if your spouse wears it, then you can't sell it. It is an expenditure. If it is gold, if you really want to invest, gold investment should be either bullion or now ETF is there or SGRs are there, gold bonds, sovereign gold bonds. You can invest on that, but jewelry is not investment. Similarly, precious stones. Then we are not into it, but I'm putting it because this is the one area where high net worth people invest. That is works of art and antiques, etc. Because that is very difficult to get, also very difficult to sell, also. If you got a Hussein at your house or somebody has gifted Hussein, if you want to sell it, it is practically impossible for you to sell because you have to go to the Sotheby's to sell or any other Indian counterparts. And in this, you have it, it's got a worth, but it is difficult to sell. Then there is AF and REITs. These are the new things. We'll come to that. This less explored area, but now it is just evolving. And we should understand more because there is an easier way of investing and good return and it's tax friendly also. This is a list I have put for long term. If I missed anything, we can have any other long term investments you can think of. NPA, that is tax. I put it covered in the tax investment. Short-term investments, yeah, first thing is savings bank investment. Now savings bank investment, savings bank account also, there are so many calls because some leverage banks are giving you interest from the day one. 7%, they give 7.25%. IDFC is advertising 7.25, I think. Then there are sweep accounts where savings bank is swept into FD so that you earn the interest. There are so many things. Those and plus interest on savings bank is not, there is no TDS on interest on savings bank. Then there are bank deposits, which is the Traditionally, everybody wants very safe investment FDs, bank FD. That is traditionally, that's what even today also average middle class person will know how safe he is with the bank deposit, not with any other investments. So it has not lost its charm yet. Though it is not that tax effective, but still it is very popular, especially in India. Then there are other deposits and bonds, the company deposits, and there are companies issue come with the bonds. There are listed bonds, unlisted bonds. In some days there was something concept called deep discount bonds. I don't know nowadays the deep discounts are not existent. I think people lost charm in that because the interest uh, change was so rampant, means the variation was so much that deep discount bonds lost its charm. But now it is not available. Now it is not there. Then there are shares, of course. Mutual funds, this short-term and long-term shares and mutual funds go everywhere. Then, yeah, you people, we can give the loans and advance to to whoever wants. There in personally in my case, I've given only loans and advances, never recovered anything. Not at least it cannot be considered as an investment. Tax investment. These are there are so many changes in that. That's why I'll just first list out, then we'll go one by one. Small savings scheme. These are the initial things. NSC. Earlier there was NSS. I think now NSS is closed. But if an NSS account is there, that continues. But you can't open a new NSS account. The withdrawals are still possible. Then there are PPF. This is very popular with the non-salary people. Even today, PPF is very interesting with a high rate of interest, and which is interest is 100% tax-free. LSC premiums, there are this only the endowment policy and cashback policies will cover under as an investment, because term policies are term policy means don't go by the name of the term. Term policy is only life, which covers only life only. Premium covers only the life risk. That is not an investment. Then there are 54 EC bonds, which we'll discuss that because there is so much confusion whether people should invest in the 54 EC bonds or not. Housing loans, people go for housing loan as an investment because you get the tax benefit. But now the tax benefit has reduced because the housing prices have increased. So if you get 2.5 lakhs and 1.5 lakhs instead of 4 lakhs, if you get also, it is peanuts to the extent of money you invest. But still considered as an investment. We'll cover that. Then NPS, this is the latest. This is Modi's gift to everybody. Whoever wants pension, you can have NPS. Ultimately, what will get, we don't know, because the basic fun of the pension was that it is inflation adjusted. But if you go for any of these NPS schemes or anything, it is not inflation adjusted. So if a youngster put an NPS today, I think, and at today's rate, if he gets 20,000 per month, when he actually retires after 60, that 20,000 may not be worth that much. It is not inflation. So to hear, it's good. Scheme is good, NPS. But because of that, it's the same thing. We, so many other colleagues at my age here. So we have taken the insurance policies and they said that you'll get the return, you'll get 1 lakh, 2 lakh, 3 lakh. But now that we got the 1 lakh, 2 lakh, 3 lakh, but the value is definitely not what it was earlier. Then there are time deposits. These time deposits, I'm covering which are tax, tax exemption, where it is covered under tax exemption. You got post office time deposits and all bank time deposits, which are covered under tax exemption. Then there is ELS. These are the investment you basically make for the tax. And many people, after the discounting new scheme also, when the tax rate is reduced, they continue the PPF because PPF is not just a tax saving investment. It is a good investment with a good return. It's already high rate. Yeah. No. See, the interest rates are high. You compare to the bank, if another thing, PPF you get is high, then plus it is tax free. So it makes it very interesting. No, the PPF and LPS, it is not definitely not adjusted for the inflation. It cannot be also. Then in that case, you have to invest more so that you expect the inflation to be high.
Yeah, next.
Yeah.
It was supposed to be adjusted.
No, NPS.
PPA.
PPF was supposed to adjusted. Oh, and there are PF and superannuation funds. These investments are eligible only for the employees, not for the general public. But in PF also, now they have started so many caveats and threshold for that. But still, PF is just like PPF. PF is a good source of investment because it is tax free. And there are superannuation funds. Every PF and superannuation in the high salary, there are so many benefits possible. If, within the threshold, you can do that, and she can get it's a good investment. As I told you, business investment, I'm not covering it. Now let's come to the try to briefly classify the investments. Now let me come to the taxation on the investments. On this, all the deposits, there is absolutely nothing. It goes by your threshold and your tax rate. So you don't get any tax benefit or anything on this, any of the deposits. There is only difference is in case of senior citizen deposits and post office deposits, there is no TDS. Ditto goes with the Kisan Vikas Patra also. RFC account is the less explored area by us, because you put a RFC account in the residence foreign currency account, you gain on the exchange gain, but you pay the tax only when you receive the interest or withdraw that, not on the regular basis. So that way, RFC is the one, and plus your LRS allows you to go up to $250,000 US without anything, up to, of course, subject to the TCS now. But you can open that, and that's one area where of course, it depends on the exchange risk, which exchange you're putting, whether you are covered under that or not. I've made a chart here. So FD usually it comes with the lock-in of 5 years, maximum 5 years, but you get some 10 years FDs also in special cases. Otherwise, on a regular basis, it is 5 years. And the NRE and RFC, there is no threshold limit or no limit up to what year you can put it. But one non-resident NRI person becomes resident, so he has got an option to continue the NRE deposits till the maturity period. So that NRE deposit can be kept as high as 10 years also. If somebody is coming back to India, so he can deposit his money in an NRE account and get the interest income and NRE deposit until the deposit matures. Although he is a resident, he gets the exempted income. This is one thing you have to explore when you get any client or anybody returns to India for good. So you can, extend it. And NRE account, you can have both foreign currency and Indian currency. That currency risk is entirely left to the person. And there is an interest difference also, because when you have a foreign currency NRE account, the interest rates are lower, and with is INR, interest rates are higher. RFC account, I said, in the taxability is same. There is no special tax on this one, etc. But in the FD, there is a 10% TDS. On NRE account, there is no TDS, no tax, something is totally exempt. RFC account also, there is no TDS. And but there is no exemption or anything. Can you move to the next one? Yeah. Now let's go to the tax saving. That is national saving certificates. You know that is interest accrued is also taxable, which is deductible again. So that way it is not as efficient as PPF. Time deposits, interest is fully taxable. The only thing is that earlier it used to come for a shorter period of 3 years. Now that also they increased to 5 years. So you don't get any clear advantage of that. I think they allow the lien of the time deposit, even the tax time deposit, they allow you to lien. So if you want to take a loan against that, you can take it with 1 or 1.5% extra interest. So liquidity wise, time deposit makes better sense than I think even the NSE also against the pledge of NSE, you get the loan. Bankers give loan against NSE. PPF, the lock-in period is a big issue because in 5 years you can't withdraw anything. Then there is periodical withdrawals which is allowed. So that is, and you can't get a lien out of the PPF account. Only thing is if you're taking business loan for your net worth, they consider the PPF. Otherwise, against the PPF, you can't take a loan. And it is 100% exempt. You are on withdrawal. You get an exemption while depositing. And on withdrawal, there is no taxation. And on earning also, there is no taxation. And the PPF, now HUF cannot open a PPF. And if you're opening a PPF account in the minors account, the 1,50,000 or whatever is the limit, which is announced limit now, that is applicable including the minors, not only you. People do that. You open separate account in separate banks and they try to goodwin. But if you are caught by any data, then your interest will be cancelled. You won't get any interest on that. So if you are playing on that also, be very careful because now as it's all artificial intelligence and all data is mapped to the PAN. So you may, they may skip once and later, sooner or later, you're going to be caught. Then there is Sukanya Samriddhi scheme. This is the tax benefit. Otherwise, I don't find any special in that. Only ATC you get the benefit. NPS, I'll go through that in a separate slide because that thing is a bit more complicated. PF, as I told you, and then 50 or EC bonds. Now I will go to the chart. Tax saver FD, it is the now lock-in period for 5 years. The deduction for ATC, that means if you take the full ATC deduction, your effective investment is less. So that if you want to convert the earning on that, you can. It looks higher because you already saved the tax. So to that extent, you are already recovered some income. Taxability, there is 80 TTB. For senior citizen, it's 50,000. So for senior citizen, up to 50,000 interest, at least somebody put in the FDs. Sale on maturity redemption, there is no taxation and there is a TDS of 10%. NSE, this limit is 1,50,000 now also. Deduction is available. And taxability, as I told you, NSE, on the accrual also, you have to pay the tax. You are not supposed to miss it. Of course, your AS data doesn't show you that interest accrued on NSE. So if somebody wants to miss it, at your own risk. Deduction, I told you as per the slab, there is no TDS on NSE. Senior citizen scheme, it's limited deduction, it's 1,50,000 and exempt in TTB up to 50,000. Then there is no separate taxation. And if the interest is more than 50,000, there is a TDS. Now, because earlier there is a limit on senior citizen deposit which they enhanced. So now there is a possibility that you may get interest more than 50,000. Then the TDS will be there. Sukanya, it is the same thing. It is exempt, and up to 1,50,000. That is with the fanfare for the girl child, etc. But I don't know whether banks ask you the details of girl child before opening a Sukanya account or not. I'm not very sure on that. I don't have a girl child, so I never tried it. Post office time deposit, once again, you get the deduction of 1,50,000. Income will be subject as per slab. Post office also, there is a provision for TDS, but because now the threshold will be higher. So if you put more on post office, there will be TDS. I think post office gives 1% or 1.5% more interest than the bank FDs as on today. And there is some schemes, monthly schemes, etc., where on the maturity you get from 2% extra you get. So at the end of the term, you make a better money than bank FDs. But with the changing interest rates, you never know because once you put in post office, it's stuck for 5 years. PF, that is now the caps are put. Interest on contribution up to 2.5 lakh per annum and employees 2 lakh employees contribution. There is a limit of 7.5 lakhs overall. And if it is more than that, it is interest is also taxed. So PF's main charm, especially for the high income groups, they used to put big money in the PF voluntarily. Now there is a cap as put. So beyond 7.5 lakhs, if there is a contribution, then interest will be taxable. And as you know, if the PF is withdrawn within 5 years, then it is taxable. There is a liability on the deduction of taxes on the employer itself, but you don't get the that flat blank exemption which you are getting. You will not get. But you have got an option, because after 5 years you need not. If you stop the employment also, there is not compulsory for you to close the PF. So if somebody has discontinued the employment in the 4th year or something, you can still continue with the PF and withdraw after 5 years and avoid the taxation. PPF, there is no change as of now. It is exempt in all the places. Now I think that income tax deduction under ATC has lost its steam, because going forward with the 7 lakh limit, if you actually calculate, you may end up, nobody will be getting benefited by making the investment. Yeah. On what? Yeah, if it is beyond 50,000, they'll deduct 10%.
Yes.
Senior citizen also. And see, now in this, I think earlier budget, they increased the limit of deposit in post office. So that in the senior citizen also, then the taxation will be there. If your taxable income is beyond 50,000 for senior citizen, then it's 30 years. And for others, it is same as any other interest. There is no exemption for post office. Only senior citizen, there is exemption. That also now restricted to 50,000. Yeah. Yeah. Contribution is taxable, interest is taxable, everything is taxable. There is no exemption. Yeah. 7.5 lakh. Yeah. Yes. Yeah, your contribution, not employer's contribution. PPF is separate. PPF is independent. That has nothing to do with the PF. PPF you can, but there is a threshold on investment in PPF itself. That's the thing. Employee's contribution, your self contribution. No, employer. Overall, it is total together. There's a capping done. How many are here are employed here? Okay. Good number. I thought everybody is in practice. So let's now go to NPS, and NPS is more interesting to the employees, because up to 1,50,000 self contribution is covered under HIC, and you get 50,000 extra on CCD 1B, and CCD 2 you get, in case of government employees, 14% of the salary, or private employees 10% of the salary. This is become sizable, especially in the government employees now with the pay increasing. 14% is a good amount, and all the government people are putting it, so their kitty becomes bigger. But as a private employees, their cap is on 10%, and I don't know how many people explore this. How many people are putting more than 2 lakhs on NPS here? Can I have some call here? Anybody putting more than 2 lakh in NPS? Yeah. Okay. Your salary must be real good. And 1B is additional 50,000. Yeah. 1,50,000 first, then additional 50,000. Then CCD 2, if your employer contributes, then that is the limit of the salary. There is no threshold on the how much is the amount threshold is not there. And there is one query yesterday received. If you change the manager, what is the taxation? As on today, as per the law, what says is if you change the manager, it is considered as redemption. So whatever is the taxation redemption will be applicable on that. Now going for the taxability of the NPS. partial withdrawal exempt up to withdraw. It's exempt up to the withdrawal amount is up to 25% of self contribution. There is no taxability. Sorry if there is some jumbling error while drafting. And then purchase of annuity. It is exempt on purchase of annuity upon attaining the age of 60 or superannuation. Superannuation need not be 60. If you are retiring, it will be 58, 50 also on superannuation. Under section 80(60)(5). However, the subsequent income from annuity is subject to tax under section 63. It is when you receive the annuity, just like any LIC annuity, even NPS annuity also is taxable. So when you convert your investment NPS into annuity post your superannuation, or for us who are in practice, post the age of 60, if you convert, then on the conversion there is no taxation, but on annuity is taxable. And once if the lump sum is withdrawn, then is exempt up to 60% of accumulated pension wealth upon attaining the age of 60 or the superannuation under section 10(12)(a). Full withdrawal by nominee is tax free. If you die, if it goes to the nominee full withdrawal, that is tax free. Then annualized income, which is the annuity, is taxable. So it's the same way. I'll come to the insurance also. It's a similar thing. If you want to withdraw that, there is hardly you can escape taxation on other than what is allowed for you to lump sum withdrawal. And if your nominee gets it after your death, somebody gets it, they'll get without tax. And our generation or our earlier generation, you always believed that after me, my family should get. But I don't think the current generation believes in that. They live the life for themselves, and we also should learn that. And don't put so much money where that your family gets after wealth. Not sir?
We started to do that.
Already started. It's already begun. I think that should be the case. Why we should all we should stop on our luxuries and keep some wealth which somebody else enjoys. Why you should do that? You enjoy the first, then balance your invest. So this is the NPS. Then we'll go to laptop is not cooperating. I'm sorry, it's not mine. Insurance products, will come to the detail, because insurance products, you have got technically 4 products. One is annuities, which you get, after a certain period, you get monthly payments. Annuity monthly, you have got an option to that annuity to get monthly, quarterly, or half yearly or annually. Because I got one annuity which I took in my younger days. So now I saw that figure was coming so slow. I made it quarterly so that it looks like some sizable. 5 figures को कुछ तो आता है, नहीं तो 4 figure हजारों में आता तो उसको दिखता भी नहीं है. It's those annuities are taxable. Then money back policies, endowment policies. There is a difference between money back policy and endowment policies are not much, because money back policies are the endowment policies only. Only thing is you get the periodical money back. In the endowment, you get at the end only. There are so many insurance products. Some endowment policies after the maturity also still the life is covered. So many things. When the insurance companies sell, they sell it, and after once you buy it, you forget it. This is a natural thing. Now let's talk about the 10(10)(d) exemptions, because 10(10)(d) exemption has gone through a lot of changes over the period. So we have to understand whether you are covered under exemption or not. By definition, all the insurance proceeds are covered under 10(10)(d). Now, which is not covered? Keyman policy receipts. Keyman policy receipts. Now, Keyman policy, what happens? Company buys a Keyman and it's assigned to the director. And earlier, before the clarification, what we used to do is you assign it before the term is ends, payment term ends. Then the employee pays the one insurance policy, and because you paid the policy amount, it was covered in 10(10)(d). They've removed all. Now, Keyman policy, whatever money received is not exempt, not covered on 10(10)(d). Now, regarding the Keyman policy, there is no clarity what should be considered as your cost, whether full money is taxable or not. In case of company, there is no confusion because you take the exemption of policies, and when you get the Cayman proceeds, it is taxable. But if it is assigned to the employee and employee paid the assignment amount, what is deduction? There is no clarity. Because if you go for the indexation as a long term, you end up in a loss. And if you don't take the indexation, then you have a huge profit. But anyway, now let's come to the now. What is the clarification given in this budget for the policies beyond 5 lakhs? We can take the same stand for the Cayman policies, probably. That is, you get the deduction to the extent of what you paid. Means if this only applies to the assigned policy, not applies to the company receipts. Then first, it came that premium is not less than 10% of the sum issued. That is for the issued after 1/4/2003. When the first it was 2003, they said 20%. If your premium is more than 20%, then your proceeds are taxable. They are not covered in 1010D. Then 2012, they came out with the improvement of that. Now it is 10%. But anyway, that's insurance companies are much better than that because they find out a way how to present it. They say some issued is less, but guarantees more. There's so many things. And some issued 1 lakh, but on your maturity, you'll get 5 lakhs. There's so many schemes there coming. So it is taxable. Now, here biggest problem is, how will you know this? When your client comes with the insurance proceeds, whether this clause is applied or not, how will you know? This is $1 million question. We don't have any ready answer for that. Only one thing I can tell you is a practical approach, that if there is a TDS, then you are not covered under 1010D. If there is no TDS, you can easily say that I'm covered under 1010D because insurance company has taken care of it. If anybody else other views, we can definitely share it. Then unit link policies. That is, that change came in 21. The unit link policy issued after 1/2/21 are treated just like mutual funds. It's, but you don't get the exemption as it was earlier. So for that, if the 10D exemption will be denied only if the aggregate premium exceeding 2 lakh is paid. Here, they clarified it. If you have taken multiple unit link policies, together also you should not cross 2 lakhs if you are invested after 1/2/2021. Any earlier ULIP policies are not brought into the taxation, but after that, and I think when ULIP policies are like mutual funds and they are usually linked to the mutual funds, and you are paying 90% of the people invest in the unit link policies for as an investment, not as a life cover. Life cover comes an extra because insurance companies sell them, so they give extra life cover free. Actually, it's a mutual fund with the life cover thrown in free. This told you it will be this one. Now this is the one after 1/4/23. There is a change. If you got any now, thankfully the Modi government. I don't want to give the credit to Nirmala Sitharaman because before her also it's the same thing. We are not getting any retrospective amendment. We get in the prospective amendment. We should be thankful for that. Now, whatever is the insurance policies where the premium exceeds 5 lakh, this also once again it's all policies, not one. That's aggregation. Not if you got multiple policies of 5 lakhs, you don't get it exemption. Issued after 1/4/23, and here this 5 lakh, it excludes the ULIP. ULIPs are governed by separate rules. This is non-ULIP, where the premium exceeds 5 lakh. I think 5 lakh is a small amount now, because if somebody really goes for the insurance or ULIP, 5 lakh is a small amount. Then taxation will be here. They have clarified it is under other sources, and you get the deduction for the premium paid. There is no indexation, no inflation adjustment, nothing, but you get whatever is actually paid, you get the deduction. So by definition, this policies beyond 5 lakhs now doesn't look interesting at all, because there are so many other investment where you get the indexation benefit. Anyway, that will come to that, because on the bonds and debentures and mutual funds, once again, the indexation benefits are withdrawn. So there is a level playing field. But as now, insurance policies per se are not interesting with this taxation revenue, this regime. After 1/4/23, I think insurance company must have come with the new product to counter this. But overall, their business definitely is affected because of this. And all the insurance companies now concentrate on selling the unit-linked products than any other products. Because in India, conservatively, there are very less people who go for the pure term insurance, other than some high-flying executives. And plus, if you take a heavy housing loan, then the housing loan, your lender will insist on the term insurance. Other than that, we do not take much term insurance. We always go insurance for traditionally insurance seen as an investment rather than life cover. This all insurance policy comes with one better thing. In case of death, whoever gets it, it's all exempt. All this 10(10D) non-applicability clauses will vanish if somebody gets on death. So if you really want to give some wealth to your successors after death, you can definitely go for that. I think same thing, I put it on a chart. There is no lock-in period, because you can take the term as you wish. Reduction rate is available in all the types of policies. Limit of 1,50,000 is there. Annual income taxability depends on the slab. Then sale maturity, I've covered each and every one. In the annuity, if you while vesting with you get the 1/3 commutation amount that is taxable, tax-free. So that you can avail. If you've got any annuity policy, when the term ends, before the annuity begins, you can commute 1/3 and get it tax-free. I'm already having cold, and this blowing is direct. Money back policies and TDS will come, and TDS, as I told you, TDS is your checklist to consider whether it's taxable or not. We have covered the exemption and the taxation. Now coming to bonds. I've covered these 4 things. There are private bonds. That means private companies, all the blue chip companies come out with the bonds which are safe. And nowadays, it all comes with the credit rating. So with the rating, if you invest with the good rated companies, the chances of you losing the capital is bare minimum. But you never know, because when the big company like Jet can go bankrupt overnight, and go will go away in a day. So you never know what will happen, because there is nothing like actual safety. But comparatively with the ratings and the credit ratings, etc., you can select on some companies which are safe, and you can give that. And if you're thinking of investing in bonds of Infosys or TCS, etc., because they are all cash surplus, cashless companies, they don't go for bonds. Only companies like Tata Motors and Tata Steel are the big companies. They sometimes come with the bonds. And these bonds, there are listed bonds and unlisted bonds both. Listed bonds will give the liquidity of selling an item. It's not that easy to sell listed bonds also in the market, but that avenue is open. Unlisted, then you have to keep it till the maturity. You don't have an option there. Government bonds are very interesting when it was when they issued a lot of tax-free government bonds, because you're safe, you're tax-free, and you're done. Nowadays, the tax-free bonds are in the market. There may be something available, but it is already price is adjusted to the tax benefit. End result, you don't get anything tax-free bonds. All the government bonds are taxable, and only SGB, sovereign gold bonds, are indexable. Other than that, All bonds by definition you don't get an indexation. Bonds and debentures by definition you don't get an indexation. This is a special scheme they have put, sovereign gold bonds, which are indexable. Other than that, all the bonds are you have to, whatever is the realization amount, you have to pay the tax. Now here the question comes, when you pay the tax, on accrual or on the maturity. We have learned that as an individual, you got an option to go for the cash system. But now cash system is once again it may not be acceptable, because if there is a TDS, they will deduct the TDS on annualized basis on the accrual, and same accrual they'll upload in the SFT. It will come in your AS also. In that case, you got no option than offering the same to the tax. So you can go by the cash basis. Technically, it's allowed, but you will be subject to questions, scrutinies, answers, etc. And in the faceless regime, you know how difficult it is to get some solution to any problem. You get only problem, solution will and eventually it may come. Earlier CP gram used to work. Now CP gram also is waste. You don't get the result from CP gram also. So all the taxation here technically will be, whether cumulative also, taxation will be on the annualized basis. You should get the interest amount and offer to the tax. You don't get any benefit whatsoever in any of the bonds for the taxation in this. As per your slab, you pay the tax. I put the chart. Now, only thing is I put capital gain bonds also in this. 54 EC bonds. Yeah, this comes with the law. Now, earlier it was 3 years. Now it comes with the 5-year lock-in. And the interest rates are absolutely low. And it is, once again, it is taxable. And you can't lean it. You don't get anything. Means practically that money is locked for 5 years other than the interest. So interest is fully taxable. And these REC bonds, they do not deduct the tax at source. Just because they do not deduct the tax at source, don't get an impression that it is not, it's tax-free. It is taxable. And what I've seen is, if you are assured of now you get more than 8% interest. If you're getting 8% interest on the top slab, paying the tax, capital gain tax, is more advantageous than putting in the 50 EC bonds. Earlier, it was the 8% assurance was not there. Now you can practically get assurance of 8%. So if you're if somebody is insisting on the bonds, you have to tell them. I always tell everybody not to put in 50 bonds, but still, all the senior people, they somehow and especially when people get one-time capital gain, that is what is when they sell the house or change the house, etc. They always feel comfortable putting in the bonds. So bonds is still very sought after tax saving device. And as if you ask me, there is no tax saving. Pardon? Now it is 5.25, I think. I think 5.25. Yeah. It was 4.75. Now I think it will increase to 5.25. And it is a fixed rate of interest. Once you take the bond, if the interest rate increases to 10% also, you don't get the benefit. You get the same old rate. Now coming to the shares. There are listed shares and unlisted shares. Now the listed shares are simple. It's a short-term and long-term, STD paid and non-STD paid. These are the only for classification. And if it is not STD paid, you can go for the indexation. And if it's listed, then you got the chance. There is bold provision of 10% tax without indexation is still applicable to the listed shares. Now this is a common query by maximum people, even the learned people, chartered accountants and clients, etc. say that no, without indexation, I am eligible for 10%. That scheme is available only for listed companies. If the shares of listed company, there you have got the scheme of 10%. Otherwise, you do not have. On other assets, you don't have. You have to pay the tax after indexation. Unlisted shares, you have to take care of the valuation, because if you sell it below the value, above the value, either way, it's above the value is not a problem. If you sell the below the value, it's taxed in both places. 50CA, seller will be taxed for additional income, and 56(2), buyer will be paying the tax, and buyer will be paying at a higher rate because seller has got an option, maybe short term or long term, but buyer will be paying full tax at whatever is the maximum marginal rate. So if you are dealing with the unlisted shares, make it sure that you get the valuation done. Valuation paper you should have, because just looking at the balance sheet and dividing the net worth number of shares is not the valuation now. Now 11 US changed. So if your immobile property, if you are going for the book value also, you have to compulsorily revalue the immobile property as per the stamp duty rate. Then don't buy any unlisted shares below that. You can, there are so many ways. If you want to have a settlement, you can change it. And if you're buying below that, we pay the tax on the difference. You see, you can go for the valuation. There is approved valuers. They can value the way they want. Okay, that is one option. No. That's what I'm telling you. If you want to value book price, book value, if as a chartered accountant you want to study for the book value, then you need not see the defects on the property, etc. You have to see what is the stamp duty reckoner value of as on the valuation date. You have to add it. If you want to change it, go to the approved valuer. He will refer it to the. He'll take the shelter of approved valuer for the real estate separately, finance, because valuers for the real estate is immobile properties are different, and valuers for the financial assets are different. So he will get the valuation done by the immobile property valuer, incorporate that, then issue the value for your financial asset. It's a process. And if you're going for the settlement, don't skip it, because if you buy it at lower rate, taxation will be full marginal rate, 30%. Yeah. I will come to that. We'll come to that. We'll come to that. We'll come to that. Any item which is not covered will take later. But I intentionally put the immobile property last, because that can be talked for hours and hours. So I look at the clock and then stop. So till then we'll cover the other item. That's the idea. Non-Indian shares, now you are allowed to invest in the foreign shares. And foreign shares comes, there is a DTA benefit, because there your company will deduct the taxation on dividend. To the extent of TDS, you get the credit here, and foreign dividend is taxed at a special rate, and capital gains are taxed at the regular rate, Indian or that, and you won't get the benefit of 10%. You can get the benefit of indexation, and pay the tax long term or short term, because long term, short term will be equivalent to the unlisted shares, because they are not listed in Indian bourses. So now that the additional problem is, when you invest, when you remit money, there will be TCS. Beyond 7 lakhs, if you invest, there will be TCS, which is going to be 20%. So that's going to hurt you if you want to invest in the foreign companies. And that taxation is just exchange rate on the sale and purchase. You value at the date of sale and purchase, and you need not pay any tax on the accrued income. So you need not other than for filing the AL, you need not worry about the valuation of stocks at the end of the year. Buyback of shares with or without STT, because buyback of shares in the unlisted companies, there is separate provision where company pays the tax, and in your hand it is tax free. And in the case of listed companies, now because non-STT shares were their tax liability higher, they are come out with a scheme where they pay STT, then buy back your shares. Then it will be just like any other shares which are sold. So taxation is same. Otherwise, you will get you have to go for the indexation, short term, long term, etc. But you'll get the benefit of listed shares if it is listed. Unlisted, you are good. That is a tax-free income. You enjoy the money. And that is seen as a tax planning, because the buyback works out cheaper than the dividend. So if there is a private company, if you want to distribute your accumulated income, buyback works out cheaper, because it is 20% plus cess and charge. and if you pay as a dividend route for the person, it will be 30% plus surcharge and cess. So that is this here. There is a clear benefit of 10%. Of course, it is subject to limits of the residual reserve test, 25%, etc., etc. But that is cheaper than the dividend option. Then there is open offer to purchase from the share promoter, etc. It will be once again, there is STT route and non-STT route. If they do through the STT route, it's then just like any regular sale. Non-STT route, then a listed company, you get long-term benefit for the more than 1 year. If it's anyway unlisted, we are not discussing here. Yeah, same thing I put in a chart. Listed shares dividend is taxable as per the slab. Unlisted shares, so it's the same. And the STCG rates are different for the listed shares, and unlisted shares it's different, because for unlisted shares, it will be as per the slab. For listed shares, you have got 15%. Long term for listed is 1 year, and for unlisted is 24 months. And the grandfathering is available for the listed shares, and unlisted shares grandfathering is not available. But if you got purchase unlisted shares are acquired before 2001, then that valuation as per 1/4/2001, that option is available. Other than that, you get only the indexation benefit. Grandfathering is not there. Anyway, the grandfathering is specially brought in because your capital gains were tax free. Those capital gains are never tax free, so it's not that relevant. TDS on dividend is the same for both, is 10% beyond 5,000. Foreign shares, I told you, that is here the holding period is, although it may be listed in the international bourses, but for you, holding period for long term is 24 months, not 12 months, because it's considered par with the unlisted shares. Buyback, I told you that we covered it. There is nothing special here in this. Yeah, you can go for the valuation on 1/4/2001 based on the book valuation of the company, and take the indexation on that and claim the benefit. You have to go by the book value. Yes, yes. If it is actually technically even the bonus share, you get the benefit of that. If the bonus share is issued in before 1/4/2001, then whatever is the whatever is the book value as on 1/4/2000 will be a cost. Then you get the indexation. No, listed is market driven. Market driven. It's you get a grandfathering. You are out of that. Listed company, if you bought before 1/4/2001, you are out of it because you have got a grandfathering clause on 31/1/2018. Yes. You are eligible for that. You are eligible for that. You should take that advantage. Yeah. Coming to mutual funds, the life is different for the debt funds before 1/4/23 and after 1/4/23. Debt fund after 1/4/23 is termed as market linked debentures. That is the terminology used by the income tax amendment, market linked debentures. But mutual funds have given some separate name for that. I think if somebody is in the market, they will know. I forgot the name. They give it a separate name. But anyway, now it is taxable. Exemption are gone. What is equity fund? Where more than 35% invested in equity. So that, of course, term sheets and other things are available in the websites. But you need not worry that that fund house will declare whether it is the equity fund or non-equity fund. Then there are fixed maturity plans, exchange traded funds, investment funds, and alternate investment. We'll go one by one. Now, debt fund, if it is before 1/4/23, you get the exemption, and the same you get the indexation and the long-term benefit. And that is how the fixed maturity plans are also given, where on the maturity you get the amount, and we used to get that index adjusted funds, etc., where they will give the return in such a way that you don't pay any tax on that. This is the fixed maturity plans are all worked out. But these are all now history, because henceforth going forward, after April, whatever you invest, you don't get indexation, you don't get any tax benefit, and there is no long-term benefit also. Whatever is your income, it is taxed as your regular income at the maximum marginal rate. Exchange traded funds, ETFs, these are the products which are linked to the exchange, and you get exchange traded funds in gold, silver also. Don't confuse it that ETF gold is different and SDR is different. There is a bond. This is the ETF fund. ETF fund, you don't get any benefit. In case of SDR, you get some interest also.
2.5.
Yeah, but yeah, in this, it is ETFs are adjusted to the market rate of the gold, but you don't get anything beyond the market rate of the precious stone. But in case of SDR, it's better to invest in SDRs than in the ETFs. And ETFs means ETFs on the gold and silver, I'm telling. Other ETFs are, it's your call. The ETFs do not qualify for the equity funds, so you don't get the benefit of the indexation and capital gain going forward. Then there is investment funds and alternate investment funds. I'll tell you how the system works. They are considered as a trust. What is this called as walk-through entity? That means they will take your fund, they will invest, they will give the statement annually what is your accrued income and realized income, and based on that you pay the tax. They don't pay any tax. That is called walk-through entity. And you got some special person. I'm just a reference. I'm taking a special person. If there is a estate, etc., there you got both options. In case of a special person, tax can be either paid by the special person itself or by the beneficiary. There is no double taxation. In this case, this walk-through entity, it doesn't pay any tax. Even AFs and this REITs, and there are so many other things there. They have introduced 4 years back, but nothing has actually taken off. AFs are big, but not with the common people. They are big with the corporates and other institutional investors. AF is big. In corporates, the non-corporate or individual, there is, the trust value is not that much with you don't know which is fund manager. After AF, what happens, what will happen? People are a bit skeptical, do not invest much on AF. But this AFs are just like mutual funds. A similar chart here. Lock-in period, only in case of FMP, there is a lock-in period because it comes with a fixed period. This fixed maturity option. Other all come with the open-end schemes. And even the open-end schemes also, they close the scheme periodically and they stop taking from subscription, etc. So in that becomes a closed-end scheme. Tax liability, dividend is taxable as per slab. And maturity, debt mutual funds, this is before the 1/4/2003. That's the short-term capital gain. Here the time limit is 36 months, not 24 months. 24 months is for the unlisted companies. So this bonds and all, it is 36 months. And now moving forward, there is fully taxable. Equity mutual funds is just like listed shares. So this is more than 12 months, it is 10%. Less than 12 months, it is 15%. And in equity mutual funds, you get the grandfathering also. And the mutual funds, some of the mutual funds give you the working along with the grandfathering, and some of the mutual funds do not give. That you have to work out. But the database is available where all the mutual funds you can get the rate as on 31/1/2018 for grandfathering. Yeah, moving forward, you don't get neither indexation benefit, not long-term benefit. Both are withdrawn. No, either long-term. So your tax at a maximum marginal rate only, whatever surplus you get. Pardon? Yeah, capital gain. Gain means whatever you paid, subscribed, that you get the deduction. On the difference, you have to pay the full tax. ETF, I said ETF, if it is equity oriented, then you get the grandfathering. If it is not equity oriented, you don't get it. ETF gold is the equivalent. Gold is the other metal, debt, etc. It is equivalent to the debt security. And TDS on dividend beyond 5,000 is the same thing, applies to everything. Yeah, now coming to other commodities like gold, other precious metal, precious stones, etc. You don't get any special tax benefit on that. But now gold, physical gold, buying and selling may be a bit difficult. But if you the demat gold or any ETFs or SGRs or any other mode, if you've got precious stone, that you can sell just like shares and stock. Liquidity is there. More on gold, we have got specialist in gold sitting here. He'll tell us. Same thing ditto with the other precious metals, etc. Now only see gold. If you get the if you got old gold, because now earlier everybody has to declare the gold and jewelry etc. under the wealth tax. Now wealth tax is history. It's more than 80 years since the wealth tax is already stopped. So now if you want to sell your gold, you want to sell your gold, then you got an option to go for the 1/4/2001 rates. But that doesn't give you much relief, because the gold rate is multiplied more than 10, it's more than 10 times of the 2001 rate. So you end up paying the tax on almost 70% of your receipts. Other than that, and plus you get the 54F benefit on the sale of anything. Now, work of art, that is this is a bit tricky, because if you purchase a work of art and sold it, it's like a capital asset. But you have got your own work of art and if you sold it, other than the professionals, it is like a personal asset. It is not taxable. Just like if you sell your car, it is not taxable. Just like that, if you sell a work of art, it is not taxable. If you're an investor, then it is less like any other capital asset. Other than it is not. And people have taken shelter under this for receipts by telling that I've sold my work of art and I got the money. Whereas capital builders, many people have used this technique. Whether it worked or not, I don't know. But that is still there. It's not taxable. Just like agricultural land, even your own work of art, or if you have not purchased it, it is not taxed. Then the last thing, virtual digital asset. Now this is, I know during the last budget, we introduced that. They made it taxable. This is taxed. Last tax 68, 69 and 69A, even this is also taxed at maximum marginal rate. Whether you have got any other income or not. If you are below the slab also, whatever money reaches you out of sale of virtual digital asset, and it is taxed at a maximum marginal rate. Now, by definition, this virtual digital asset, we mean cryptocurrencies. But the definition covers so many other things also. There is not a big clarification issued, because there is we had a lot of discussion what are the virtual digital assets. Even the credit card points you get also is virtual digital asset, which you encash. So, but anyway, there is no clarity, and the whole purpose of bringing this section was to tax the cryptocurrencies. I think cryptocurrency has lost the steam also now, because even now rates are not increasing, and there are a couple of cryptocurrencies which become close bankrupt. In the process, it is not the very sought after item as on that day, as in today, and the legality in India is still a question mark. So, as an investment to cryptocurrency, you have to do at your own risk, and there is no benefit, and you have to pay the maximum tax on all income. It's the same thing. Crypto is 30% full tax. Investment in AF If it is if the fund is paying, then it is exempt. Otherwise, you have to pay. It's the walkthrough entity. Hedge fund is same thing. The fund has got an alternate. They give the option who is going to pay the tax. We see it's venture capital. It's your investment. You pay the full tax. Gold we discussed is 36 months is the holding period for the long term. And long term also you don't get a big benefit, it's 20%. And in case of corporates, long term capital is LTCG tax is 20% and other income is 22%. So there is only 2% difference. Work of art, we discussed that. If you purchase it, then you claim it as any other asset. Now we'll come to the last thing in my presentation. That is the taxation on immovable property. In case of residential, you get benefit and you can take benefit under 54 and 54F. And in case of commercial, you get only 54F. And in the case of commercial, you can take an advantage of the block of assets. Then there is redevelopment. It's one area where the taxation is a big question mark. Then there is in the redevelopment, there is a combination of things: permanent alternate accommodation, compensation, hardship allowance, rent, sale of extra area, etc. Then there is a CGS account. Then there is a RETs. 54, I think we are all clear. Or anybody is not clear? Let me just rush through that. It is residence to residence. One resident, another residence. It doesn't give you any restriction on how many residents you are having, etc. Then plus one resident or two residents are allowed if your capital gain is less than 2 crores. Now, what is the change made during the year in 54 in this budget? 10 crore. Now, beyond 10 crore, you are not eligible for 54. So there is a big rush after the budget to register so many properties because they wanted to claim under section 54. It's less complicated here, and here you have to invest the gain only, not the amount. Yeah, gain in property 1 or 2, and you can sell more than 1 and 2 and invest in 1 also. There is no restriction on selling more property and putting in 1. So that is how you can put in 54 and 54F also, because that asset you are selling and you are investing the property. And 1:2 also is now allowed, subject to the condition of 2 crores. And overall 10 crore, your 54 closes the door if the gain is more than 10 crores. Then no, you are out of that. You are out of that. Then non-residential, non-residence, I put it as commercial. You get the 2 things possible. One is block. If you are in the block of asset, depreciated asset, you can claim the tax benefit under block if you have got different block, etc. There you remember, everybody makes one mistake there because they sell one commercial property and buy another commercial property under construction. That doesn't work because for the block of asset, you have to put to use. If you sell it in now, if you sell it in March and invest in April, you are not in the block of assets. And if you are sold in April and purchased in March, possession you got in April, then also you are out of the block of asset. Put to use is the condition. So if you are taking shelter under block of asset for commercial property, you should be very careful in sale in the beginning of the year and see that your other properties put to use. Because if you buy another property also for furnishing, etc., you will take 6 months, 8 months. Then if it is not completed, then the put to use can be questioned. Then 54F. 54F, yeah, you should not own more than 1 property. Now here, always the question mark comes is if it is a joint property. If you are having 2 properties, both are in joint name. how do you are you eligible for 50 or F or not? This is the question mark with everybody. But what stand we are taking is you take the first name. If the both are first name, then you are not eligible. Because you can always declare that second name is only for nomination. But many times happens that money is paid by one person but registered in two names. So although the right-wise it becomes equal, money is not paid. In that such cases, you can always claim that second name is only for nomination. So hence, one person in first name, another first name, you are eligible for 50 or F. And 50 or F, the basic difference is that it should be full amount. You get the proportion to the sale proceeds, not to the gain. This is one big difference between 54 and 54. Yeah. And it is not only commercial assets, any other asset, if you sell, you get the benefit under 54F. You can claim the benefit of equity shares also. If you got long-term gains in the equity shares also, you can take use of the 54F. And if there is a, for example, you sold one house and purchase another house, you can take simultaneously 54 and 54F both. Only thing is, see that you don't overuse. If it's a say, if the investment is 200 rupees, out of that 100 rupees is 54 and another 150, 54F, it is fine. But you cannot say 100 rupees in 200 in 54 and 254F, you cannot do that. It should be overall within the limit. Overall, your total investment should be including both 54 and 54F. Yeah. If it is depreciated, then it is in the block of assets. You are not eligible for any long-term gain. But now if it's a depreciable asset, if you stop depreciation, then in that case, your cost will be the return on value as on the date when you stop claiming depreciation. And your long-term calculation will also start from that day. So you still, because there are so many companies close, their asset is there. So they can claim under 50 or F. And even the long-term also, you can claim under that. Huh. See, now the thing is, this is the question generally asked by everybody because it's paid by one person 100%, but he put it in three names. But here, unless you mention in the agreement, the right on the property is always equal. If you mention in the agreement, any percentage wise, whose percentage is what, and if you mention that two names are only for nomination purpose, if it is part of the agreement, then you can take a shelter. And buyer usually he takes your indemnity and affidavit, then deducts in one person if you ask for it. If you ask me, that is not a conclusive evidence. It should be only if the agreement contains particulars of the sharing, then you can go by that sharing. Otherwise, it's always equal. If there is 3, 4, 5, how many number of holders, everybody's share is equal. Before,
let the other party become only confirming party.
You cannot, because then you are defective, your title will be defective, because the agreement is in three names, and the confirming party is if you have got right over it. If there is a dispute or anything, then there is a confirming party. One second, let him complete. Yeah.
So originally property was purchased by three persons. One person, Mr. A, has paid the whole amount. It was the real fact. Okay, it is not mentioned in the buying agreement. Now, by selling, you can make this agreement. Yes, or accession of the capital.
No, it's a good idea is given. If you taken because I had a doubt on the title of that property, because the ownership is 3 and sold by one person. But if you taken the opinion, and this is a good idea which we can use, because this problem is rampant, and then especially the TDS. If based on that, if that person deduct TDS on one person, then although we talk so many technical things, if tax pay, tax here, tax there, etc. Then ultimately, you pay in one name, and in the AS data there is a sale of property listed, and you are not offering, then there will be scrutiny. So what idea he is given, it works fine, because the confirming party is on the TDS also not deducted, and because confirming party, even the registrar do not send the PAN data of the transfer. Because if you sell one property, that in AS data, there are two places the data comes, one from the registrar, another from the TDS. So with this, we can avoid those two. See, this is the advantage of having a meeting. You can get some new ideas. And title, I'm not very sure. I go by face value. Yeah.
The property is gifted by say father.
Gifted.
Property gifted by father to sons of Putra sharing, and then it is sold. Now, in the sale agreement.
No. See, anyway, this got nothing to do with taxation. But I'll tell you, if the for the taxation concerned, gift is not regarded as a transfer. Okay, that is, keep it aside. For the taxation purpose, gift is not regarded as a transfer. So it is the cost to the father only will be the cost here. Now, if the gift is gifted registered in two names, then the buyer has to buy from both the names. He can't do that one name. Yeah, because it's in his case, what he said is that payment was done by one person. Here, whoever has paid has already gifted to two people. That is matter closed. Yeah, that they are already recognized as equal owners. You can't change it. There is a 45(2) conversion of investment to stock in trade. This one, if you are having a piece of land or a piece of usually it's in the piece of land, and if you want to develop it, then you can claim benefit under this 45(2). Here, how the scheme says is, you introduce your investment as a stock in trade, and when you introduce stock in trade, you value it. For example, you have got some ancestral property, the land, your cost is 0. 1/4/2000 value also, let's say 10 lakhs. As in today, you want to develop it and make a high rise. So you convert the land into a stock in trade. Then you value it as in today. Let us say it's valued at 10 crores. Then you don't pay tax this year. You pay tax when ultimately that redeveloped product is sold. Now, when you sell the full high rise, you sell for, let's say, 100 crores. In that, 90 crores should be business income minus your construction cost, whatever it is. And 10 crore will be long-term capital gain. And this capital gain will be paid when it's ultimately book the sale. This is one deferment of tax that is legally allowed. This has to be explored. Yeah, then then see how much sales you are recognizing, proportionately you have to offer the capital gain also. You have got that. You got a formula for this construction contracts. ICS declared that based on the formula, recognize the sales. When you recognize the sales, no, proportionate for same proportion, because in that formula you have to calculate what is the total sale value also. So then proportionately offer the capital gain also, and whatever is the adjustment, it will be done in the final year. Because when you get the occupation, whatever is unsold also will be considered as your finished goods. Then you pay the full tax each year. Yes, that is the 45(2). This is one provision. This is the more important for the tax planning point of view, and then the tax payment. Then coming to redevelopment, I tried to classify what are the agreements done, usually you go for the redevelopment agreement, which is registered and stamp duty is paid on that. And then afterwards, there is a PAAA, that is Permanent Alternate Accommodation Agreement. So PAAA is not a transfer. So on PAAA, there is no taxability. That's what the court says, because you are getting one instead of another one. So there is no taxability. Now here comes, when the PAAA comes, you get 30% extra than original one. Then now the departments have raised question that 30% is your income. On the extra one, you pay tax on that. You and some, I got multiple assessment on the same issue. In some assessment it is accepted, some assessment it is going on litigation, because there is alternative theories are possible. One is it is covered in the PAAA, that's why it is not taxable. It's a simple, straightforward, plain vanilla. PAAA, there is no transfer. That's why you are not paying any taxes. But what they're telling is it's your income from other sources, 5210 or whatever, some section there. So.
It is a residential project.
Yeah.
area. Value करके, then you take deduction.
Yeah, that's the first alternate is you claim that PAAA. Second alternate, you say that you are out under 54, because whatever additional area you get also, it is 30%, because in 54 your taxable gain will be much less than that anytime. So that is the second option you can take. That and plus now there is a possibility that you sell some extra FSI. Unused extra FSI you must be selling separately. If it is sold separately as a compensation, the builder gives compensation for unused FSI separately. In that case, it is a capital gain and your cost of acquisition is nil. Remember that if you are selling extra FSI, then there is no legal recourse available of not paying the taxes. If it is part of your, you get the extra area, that's different. And in the same way, when you allotted extra area, you buy some extra area. And that buying also becomes a problem, because that buying, you should not buy below the stamp duty value. If you bought below the stamp duty value, even that will be considered as your income. See, because you agree for a certain rate on that extra area you want to buy, and your development project takes off after 2-3 years, and you register the PAAA on the completion, that is after 5 years, then there is a possibility that whatever you purchase rate is your stamp duty is much higher. In that case, you run the risk of paying the taxes income from other sources. That you should be very careful. Here also, once again, you can you got the benefit of proviso to section 50 that 53.210, where it says that if the agreement is earlier and payment is earlier, then that is available, but that is not accepted by the department authorities in the initial stages. That all these agreements where the stamp duty payment rates are earlier and will make payment earlier, registered later, all their assessment units are confirming the additions, then you have to struggle in the appellate whenever it happens. Yeah, there is a compensation. Compensation, there are multiple views. The Mumbai Tribunal has taken a view that compensation is not taxable, but it is not accepted of the department. And here what happens is there is a class action. If there is one person's compensation is caught, they send the 140 notice for every member in the society. That becomes a issue. So in the appellate levels, now recently in the commission appeal only I got the deletion for the compensation. But I suggest that if somebody is making the agreement, don't put compensation separately. You add it in the hardship allowance, because by hardship allowance, by definition, is not taxable. It is not a taxable. It's not an income, and it is not a tax capital receipt also. So it's falls in between. The courts have held that hardship allowances cannot be taxed. So that is the one safe area where you can cover the compensation. And if you are showing compensation separately, you run the risk. And third one is rent. Rent is exempt, is allowable. It's a compensation received to the extent of you whatever you spend, you don't offer to tax. If you have spent less, if you didn't spend, then you offer to tax. And nowadays on the rent, they are deducting the TDS also. Builders are deducting the TDS. So then if you don't offer it, you are you're in a tough space. Anyway, that you can offer in the other sources and claim the deduction under 57 to the extent of 57. 57, it is not the rental income on the property, it's a rental compensation. So take it on the other sources. Don't claim the 30% allowance.
What section is the TDS being deducted?
When it with the rent, no, when it for J or whatever it is. Yeah. See, the thing is, the builders have given opinion that you should not pay without TDS. So they look for the nearest to the nomenclature. That is the rent. Although technically you are right, it is not covered under rent, but they deduct to be on the safer side. That is what I don't deny that, I don't disagree with you. But the thing is, they want to deduct the tax because they want to be safe. And under what section do you deduct tax? So they picked up this section. That's how it works. Yeah. Then yeah. Tenancy right surrender is specifically cleared in the Act that it is taxable. If you paid anything, then to the you are a tenant, and in lieu of tenancy, you are getting the property, right?
Yes.
And so it is covered under 54F and PAAA.
Then the cost of acquisition.
Zero. But you should be first take the shelter under PAAA. There is no transfer. You got the property instead of this. But I suggest you take 54F because you can recognize that value in your books. Then later on, when you want to sell, you are safe. That's what people are exploring. And there are people who are doing that. Even rent also, they add to the hardship compensation. They sell hardship compensation, including the rent, and they give it. So in that case, you can escape. But you see, the big thing is, these are based on the judgments, that to tribunal judgments. That is not high court judgments. And it is this type of situation is very peculiar to Mumbai only. So where you man in the when you go to the AUs, they don't understand anything. So, and if if there is a officer in the Mumbai, he doesn't allow me based on that proviso because he says no, your allotment letter is not an agreement. Because word used is agreement and you make the payment. Allotment letter is not an agreement. But now even the allotment letter also they make in the format of agreement only so that you don't come into this situation. But in case of AUs, they don't understand anything. If somebody is sitting in the northeast, who knows what is this redevelopment plan? They don't have any idea.
Hello.
Yeah.
In the case of a tenancy surrender, you said that
tenancy surrender nahi. We tell
tenancy against
conversion. Tenancy conversion. Yeah. Yeah.
So you said that 54 that can be used, right?
Yeah.
So then again you have to keep in the mind and you should not.
Yes, 54F ka you have to complete the.
Can we go for 54?
54 you cannot because you are not the owner of the property.
That is the one judgment is saying that even there is judgment of the Bombay High Court. Nature or substance may become maybe less.
See, the thing is more
So,
than
my point is that one, why should we that is on the tenanted one and against so there is a capital gain on the tenancy and my investment in the new flat.
Yeah.
It's a thought, right?
Yeah. See, first of all, if the tenancy is more than 60 months, as per the Transfer Property Act, is calculated as a member property. In that case, you should be eligible for as a owner. And the judgment, I have not heard it. We can definitely, it's a good idea, this one. But it is all subject to litigation. But you go for the PAAA, that is the basic fundamental. Then that should be whether 54, 50 or whatever it is, there should be alternative arguments. Basic argument is you are under PAAA, it's not a transfer. That should sail you through. Rent, we covered extra area. I told extra FSI, we discussed that. Now 54 EC bonds. Here the one thing everybody gets mixed up with this is the 6 months from the date of sale is applicable to 54 EC bonds, not for anything else, for the property purchase or CGS account or payment, etc. It is the due date of return which is important. But for 54 EC bonds, it is 6 months from the date of transfer. Now, date of transfer, there are so many complications in the date of transfer. But you ideally, you should go for the date of registration or the date of transfer. Because what is date of transfer? There are three, the courts have held that there are three ingredients for the date of transfer: possession, payment, and registration. So, now basically what has happened is many people have registered on 31st March, 30th and 31st March they have registered. But the payment and possession, everything is in April. Then when do you show the transfer? Yeah, 31st March, because it's more practical. Because if you go for the AS data, TDS, AS, everything is coming under March. Although you get the possession and payment later, you better safe than sorry.
Next year.
But if you go, yeah, that is the next option. That is the next option. But if you carry for the TDS, AS data, they say that the investment not reported, sales not reported, they will come. Actually, the most practical approach will be go by the date of registration and go by the TDS date and AS date. That is the more practical situation. Legally, out of three, if the two are completed, then it's the transfer. Possession, payment, and the registration. Out of the three, two are completed, it's considered as transfer. But yeah, I'm talking about sales, not on the purchase. Purchase, you need not worry about that period. I'm talking about if you sold the property, then the date of registration and the same day you will deduct the TDS also. And if now that could be different problem, because you register on 31st March and that gentleman pays you April and deducts in the next financial year. Then you have got one more problem in hand. Because as per the AS data, registration is 1 year and TDS is another year. So this you should avoid. These two things you see that it matches so that you don't have any unnecessary controversy. Then CGS account. CGS account is best way to defer your capital gain tax. This is the one thing which allows, because others all things, for example, 54 or 54F, you have to complete the property within 2 or 3 years as scheduled. In CGS, there is nothing. You open the CGS, if you want to close it, pay the tax. And you don't pay any interest or any penalty or anything. So only gain you have to put in the, if it is a residential property, only gain you have to put in the CGS account. Put in the CGS account. After 3 years, if you decide not to buy, you can close it. Then you have to pay tax on that year. There is no interest, penalty, nothing. So you are deferring the tax to that extent. And once you pay the tax, that my income tax person will give you the permission to close the account. Of course, it doesn't become free, because nowadays, if you enter any officer's cabin, you have to pay something. And life was different earlier. So they don't see any people. कोई आएगा तो चलो आ जाओ. आगे का बात करते हैं. REITs are the one thing very started with very much fanfare with great ideas, etc. But which is hardly taken off. The big builders wanted to do that. It is only highlighted the individual people, and depends with the face value of who is issuing the REITs. As a trust, and the trust with the general person is not there. It's same thing with REITs, AIFs, the InvITs, all etc. Because that people are not feeling that comfortable investing in such things, because it is not government backed. It's government controlled, but not government backed. We especially middle class Indians, are interested in what is supported by government. safety first. Of course, they are investing in the shares. That is because everybody's got some thrill. The people want in life in thrill. So average investor is very simple. He will invest when it is in the peak, and he will sell when it is low. This is done by everybody other than the professional investors. All other investors buy in the peak. अरे market अभी 65 हो गया, अभी 80 हो जाएगा, चलो पैसा करो. बाद में it will go down to 50. सब बेच देते हैं. They don't have any उतना capacity किसी के पास भी नहीं है रखने का. It's a walk-through entity. Walk-through entity. Yeah. I think this we have all covered. There is nothing. Yeah, I think we had enough question answers. And am I early or late, madam? On time. Okay. So on time. So there is on time because thanks to you, people ask less question. Exam pass. अभी exam तो दे दिया, pass हो गया, fail हो गया, बाद में बोल देना. Yeah, yeah. Redevelopment and self-development is society and themselves does. So then you don't get any compensation, but that society gets the income by sale of additional properties. That income is fully taxed. You don't get any benefit on it. That society will pay the tax. Yeah, no, that is call somebody has to take, but their society gets the income by sale of property, and that is distributed, or society keeps it for anything else. Usually do not keep, they distribute to the dividend tax will come. Dividend tax will come. Yeah. There is dividend is not tax free.
But suppose in an area like Koi where the director rate is 40,000 per square foot. The building beside there is a SLA property. But income tax department has sent the notice stating that your agreement value is. After this is the SLA property having bad condition. Getting notice. Any solution for this?
The classic example is Royal Palms. Royal Palms has got the same stamp duty rate as the Film City Road, which is luxury flats. Here there is only one way out of it. When you refer to the valuation cell, and valuation cells gives the fair value. Adjudication is possible when you register. While registration, then only you have to do the adjudication and register to your agreement value. And you can save on the stamp duty also. But if you pay the stamp duty, then if department is questioning, refer to the valuation cell under 50A, and they do the good valuation, and it works on percentage basis. There is no problem.
Wait for them. Then you have to do the valuation.
No. You see, the thing is, while filing the return, you got both the columns here to fill. What is the agreement value? Stamp duty value. So you'll definitely get the notice.
Correct.
So when you get the notice of scrutiny, you refer to the DBO. You can't, without that, you can't.
Doing filing itself, you are saying we have.
No, at the time of registration, you have to go to get the adjudication. That difficult job it is, but you are whoever is the person, we advocates, they have to do that. You can challenge that also. Challenge and get an order that this is the wrong valuation. Both the things are possible, which are accepted in the department. If you have not done both, third one is go to the review. That is, review is possible only if the assessment is on. If there is no assessment, you can't refer to the review because that powers with the assessing officer while assessment only.
Thank you.
I think balance questions we can talk on the one-to-one because madam wants to close the session.
Do adjudication authority they have the power to the government ready?
Yes, that is the whole process of education. They got the rights.
No, they say we will go as per the stamp duty right now.
No, that is what the education process. No, that's what your advocate comes in. Challenge that. Yeah. Okay, thank you very much. It is a nice.
Thank you so much for this wonderful interactive session, very informative for all and useful for all. Before we close the session and propose a vote of thanks, I have a few announcements to make. First of all, we are planning to organize a blood donation drive on the next Sunday, 9th of July. Also, we will be having some health checkup personals here. So, details I will be sharing shortly. I request you all to participate in it and also motivate others at your office and at your family and friends to come and take benefit of the same. It is for a noble cause. The blood donation will be done by, it is organized by the Tata Memorial Hospital and goes to the cancer patients. Apart from that, we have with us Black Horse Excellence. These people, they have developed a Excel based utility for automation of financial reporting. So they have put up their desk outside. Anybody who's interested in taking a demo or discussing, they can approach them and ask. Now for today's session, sir, thank you so much, first of all, for accepting our invitation and working on it. As you said, you had to first work on it yourself before coming here for this. Thank you so much for that. To propose a formal vote of thanks, I would like to invite CA Vijita Jaiswalji, who's our deputy convener. Thank you, Purvi. So, as a famous Benjamin Franklin has said, we are taxed twice as much by our idleness, 3 times as much by our pride, and 4 times as much by our folly. So, it's always better to be aware, plan accordingly, and save ourselves from unnecessary taxes. Thank you so much, CA Haridas Bhat, our past convener, for taking us through the various aspects of taxation of various investment instruments like shares, derivatives, bonds, ULIP, etc., with detailed charts, examples, the recent changes and the impact, applicability, and opportunities in this field we can take as professionals. Friends, learning is a constant process, and I'm sure this cool and rainy morning, our members have learned quite a few new things and become aware of various aspects of taxation of investment instruments, the various calculations with examples, mechanism, amendments, and from time to time and guidelines, etc. Thanks to all the members who have attended this session in large numbers and participated actively to make this session interesting and interactive. And of course, the staff and management of Kohinoor. As a token of appreciation for our learned faculty, CA Haridas Bhat, I request you to please carry a loud round of applause. We will take a short break of 15 minutes and reassemble here for a second. Thank you.